Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Mark Marex, Director of Index Research and Development with Nasdaq Investment Intelligence, to discuss the Nasdaq US Buyback Achievers Index and its performance relative to the broader market. And Mark, it seems like a great place to start. Let's check out your first chart here with the index relative to the broader market.
Sure, Jill. Yeah, I mean, you're certainly hearing a lot about income strategies these days. Folks really finding, those high dividend payers, high dividend yielding stocks to be back in favor, not just because of, the preference for current income and current cash over things that, kind of far out in the future may be worth a little bit less these days, given the elevated rates and inflation that we're seeing in the economy. But also because, a lot of these type of higher yielding names tend to be more value, tend to be more quality oriented. They're the type of names, from a factor exposure perspective that investors really like for this type of environment, especially if we're heading into, a weaker period of economic growth, right? If not an outright recession. So, the interesting thing about dividends and getting income from the U.S. equity market from high dividend yielding stocks is that it really is only about half of the equation, and even less than that in many years, in terms of the actual aggregate amount of cash that U.S. listed companies distribute to their shareholders. So what I'm showing you here, before we even get into the index that Nasdaq has, that allows you to sort of track these buyback achievers, these buyback champions. Going all the way back to 2000, if you look at the S&P 500, right, that's the kind of broadest measure of the large cap U.S. equity space. It's what people know the best. Starting in the early 2000s, you could see buybacks and dividends were pretty close, about $150 billion a year. And then in the mid 2000s, really accelerated, and 17 out of the last 19 years, companies in the U.S. have paid out more to their shareholders in terms of buybacks than they have in dividends. Most recently, 2 years ago, they paid out over $900 billion in terms of buybacks. Last year, a little bit less than that, $700 billion, but still substantially above what dividends are giving shareholders. And if you look at that in terms of a yield basis, right, on the right-hand side, what you're seeing there is the plot of the dividend yield below. That's standalone dividends, right? Last year, we ended the year at about 1.27% trailing 12-month annualized dividend yield on the S&P 500. The buyback yield was 2%, just above that. So you add those together, you've got about 3.3% total shareholder yield on the S&P 500. The message of all this, of course, is that for, again, investors that care about companies that return capital to shareholders, dividends is really only half the story, or sometimes even less than that.
And Mark, what if you take a look at the dividend yield versus the buyback yield?
Yeah, so if we look at, on a company by company basis, and for this we use the Nasdaq US Large Cap 500 Index, it's basically the same thing as the S&P. You're seeing the plot of individual company buyback yield. And these, when we talk about buyback yield, you're always talking about on a net basis. So companies that repurchase their shares net of any new shares that they issue over the course of the year. You can see there's a lot of dots on that vertical left axis that fall on the 0% dividend yield plot. And the point here is that, again, when you look at a universe like the S&P 500, like the Nasdaq US Large Cap 500, it's about 2/3 of the index, 370 names that pay a dividend or do some sort of buybacks over the course of the year. But there's a lot of non-overlapping names within those segments. It's over 100 in terms of the ones that did a buyback but did not pay out a cash dividend last year. So again, not just from an aggregate perspective, but when you're thinking about trying to build a strategy that provides you with sort of all the various generators of income and yield in the US, you got to think of buybacks. You can't just rely on selecting the dividend payers and thinking, hey, you're going to pick up most of the buyback payers as well. There's a lot of companies that just prefer to do buybacks only versus dividends only versus some that do both. So really kind of got to mix and match your strategies here. That's why this index we think is such a great complement for investors that are already using some sort of a dividend product.
Right. And Mark, if you look at the DRB performance relative, I should say outperformance relative to its benchmarks, it's quite glaring.
Yeah. I mean, this is going all the way back 22 years to the year 2000. The first 6 years or so, where this is a back test, but this index has, really long live track record as well, about 16 years now. And when you compare it in the purple to, the S&P 500, that's in the yellow, you're talking about a tripling of total returns over that time horizon. You compare it to some of the other products from S&P in terms of trying to give you, overall high dividend yielding stocks, or, dividend aristocrats, for example, in the gray, you're still outperforming those by a decent margin. And again, when you think back to that chart we showed on yield on the first slide, you've got, if you've got approximately, 3% of buyback yield annualized over a long-term average, that really adds up over the course of 5, 10, 20 years. And that's kind of what we've seen in terms of, the average long run outperformance versus the broader market. This type of product, this Buyback Achievers product, it's about 3% a year annualized. So it's really material.
Yeah. And when you hear those kinds of returns, you want to know, of course, which companies are in this index.
Yeah. And if you look at, end of year, what you see is, a pretty good mix of financials, consumer discretionary, a little bit less in terms of industrials, technology, healthcare. But, a lot of the names in the top 20, right? If you go down the list, Bank of America, Bank of New York Mellon, Capital One, you've got your classic financials, you've got your kind of insurer and healthcare names, Cigna, MetLife, HCA Healthcare, and then you've got your sort of more conservative consumer names like Lowe's, like O'Reilly Automotive, Dollar General. These are not, even Oracle, right, at the top of the list here as a kind of a classic tech name, but more of a value play. Not one of the names that really has been outperforming long term in terms of stock price, but just very, consistent in terms of its focus on shareholder yield and returning that capital back to shareholders. Buybacks really, in theory, unless you have differences in tax treatment of a buyback versus a dividend in your jurisdiction, buybacks have the same impact on total shareholder wealth as dividend yield. So again, if you're thinking about income this year, if you're thinking about maybe I'm set in terms of picking up, the best companies with a standalone dividend strategy, think again, this index, the Nasdaq US Buyback Achievers, gives you that remaining piece of the equation in terms of maximizing your total shareholder yield.
All right, Mark, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.